Hello, good morning and welcome back to the channel, everybody. So I wanted to hurry and do a quick little video talking about what is going to be happening today with the Fed funds interest rate decision, as well as a summary of economic projections that we will be getting today around noon, my time at least. It will be here in, what would it be, about 3 hours from now until we actually get the release of the Fed funds decision and the economic summary of projections. So now I want to talk about both of those things really quick and kind of give you my expectations about it. And then after we actually get the official release later on tonight, I do plan to actually make a nice longer full-length video talking about everything that happens in this report and kind of deep diving into it, as well as giving you an update of where I think markets could go based on how these reports come in and based on the interest rate decisions today. So make sure you hit that subscribe button down below so you can go ahead and get my perspective later on today, a full in detail in a much nicer laid out format than this video will be. So go ahead and hit that subscribe button down below if you're not already subscribed. Okay, so now let's go ahead and talk a little bit about what's going on. So first thing obviously is the Fed funds rate interest rate decision. So there's kind of basically what the market is pricing in at this point is a 0.75 basis point hike. You know, a 75 basis point hike is what the market's got priced in, I believe, at about 92% when I looked at it last night. They do still have a slight bit priced in at a 0.5 or a 50 BP hike, but most of the market is now expecting this 75 basis point hike. I am expecting a 75 basis point hike. I think that it actually is going to be the best case scenario if we do get the 75 basis point hike as far as market movement. I think that since that's what the market is expecting, since it's what the market expects, it's what the market wants. And if we get it, I think that's going to be our best case scenario. We might even have a little bit of a rally based on that. And so, yeah, I'm hoping for a 75 basis point hike. I think it's the right decision. I think the Fed needs to get a little bit more aggressive than these 50 BPs just to try and get in front of this inflation. Okay, so now let's talk about the other two scenarios basically that we could have happen that are unforeseeable, obviously. We could have a 50 BP hike, or we could even have basically, let's call it 100 BP plus hike, basically a percent and above type hike, right? And that would be basically kind of like a surprise, you know, rug pull essentially on us. And it would be kind of a crazy thing to see happen. I think markets would freak out. So here's my opinion though on this. If we get a 1% hike plus, in my opinion, actually what will happen is we'll get a really fast stock market decline, but it's going to happen really fast. But in the short term, the market's going to go, hey, this is actually going to be good for inflation. This is actually going to help us with the problems that we're facing in the economy. It might be bad as far as like we might be strangling the economy a little bit too quickly here, but at the same time, I think that the market knows that this economy needs its medicine. So we'd probably have a sharp, fast decline, but then we'd be able to keep going on for some smooth sailing after that was all done, right? But yeah, today would be nasty if they did that. Now, what about a 50 BP hike? Now, this is where things get a little bit funny, but in my opinion, a 50 BP hike could be kind of a mixed bag. You know, market might be happy momentarily and go, hey, you know, this is good. We're still getting some slow. It's still, you know, slow decisions here, slower pace at their tightening. But at the same time, they're going to go, but this isn't actually good for the economy. The economy has inflation that needs to be handled, so a 50 BP hike really isn't that great. So it's kind of like the total opposite end of the spectrum compared to the 1% hike. Basically, instead of it being a sharp, fast, do it really quick type decline, if we get that 50, I think we're just going to keep doing a slow bleed, kind of the way that we have been for the last couple of days. And honestly, it could make it to where we keep slow bleeding for a good considerable amount of time, maybe even a couple more weeks. So it's like, to me, best case scenario, 75 basis point hike. Worst case scenario actually is a 50 BP or below, and then a 1 plus, like a 1% plus. Actually, it's like, yeah, we might get some pain, which could be a buying opportunity, but truthfully, it would actually probably be good for the market. Okay, so now let's talk a little bit about this summary of economic projections from the Fed. So if you guys have never read one of these before, and we'll go into this later in that video again, so make sure that you just subscribe down below so you can go through this summary of economic projections with me later in a future video that I'll be releasing either today or tomorrow. But anyway, if you've never been through one of these before, the biggest and most important page is kind of this little table page that they have usually right around the beginning of the report. And basically it has a median column, it has a range column, and then it also has like what is it? I can't even remember exactly, but it's got a median column and a range column. Those are the two most important columns in my opinion. And so basically, right, what it is you get a real GDP amount up at the top, and you have some columns for real GDP. You have a column for unemployment. You have a column for PCE inflation, and I think it's PCE core inflation. or it's producer inflation, okay? And then down at the bottom, then it gives you basically what the Fed sees as their path for monetary policy, basically where they think the interest rates should be in order to kind of fit along the lines of where they see the economy going from here, right? So there's going to be a couple of important ones here. So really the first thing that's going to be extremely important when this comes out is that GDP number, because as of right now, they've still been predicting, I think it's like a 2.8% positive GDP for the year of 2022. So if all of a sudden now we start getting people shifting in the Fed and saying, well, you know, things are looking worse, we're not really sure, maybe this recession is going to happen. Even if a couple of board members do that, we'll see that displayed on the range and the dot plot sheet that we'll also go through in the video later today. And so we're going to get a really good idea of where the Fed's head is at, and not just the chairman, but the whole entire Fed today. Is there anyone even at the Fed that is considering the chances of a recession? And if there is, the market might not like that very much, because truthfully, I think the market is still not fully pricing in a full-blown recession yet. I think that they're kind of, you know, following the headlines. And right now the headlines are kind of saying 50-50 from what I can tell, at least. But, you know, truthfully, I think it's a higher chance of that. I honestly think that we're going to have a recession. It's just inevitable. And so truthfully, yeah, it's going to be interesting to see how the market reacts to if one of these guys in the FOMC does wind up saying, yeah, we could possibly be a negative GDP for 2022. So other than that, though, what else is important on here? Well, obviously we get unemployment, and that's also going to kind of dictate whether or not they see a recession coming. So if we start to see them going, yeah, you know, unemployment might rise while GDP might fall, even if they don't say it's going to be negative, then quite frankly, them rising an unemployment figure and lowering a GDP figure, it doesn't look good. That's kind of like a signal of like, yeah, we think we might be starting to get closer and closer to a recession, but without them totally coming out and saying, yeah, for sure there's a recession coming. So now what about the inflation numbers? Well, the inflation numbers are very important, obviously, because we want to know what they think is going to happen with inflation going forward, based on what they think is going to be happening with this monetary policy as well. And we can kind of get an idea of when they're seeing, you know, certain marks in inflation as far as how fast it might start to decline going forward from 2022 out forward, 2023, 2024, you know, etc. So that's important, but it also plays into basically their Fed funds rate projections and basically where they're trying to get the Fed funds rate to. And so I think it's going to be really, really interesting to see, but they basically give you like an end of year goal for every single year, including 2022. And that's the one that's going to be important, in my opinion, is the median range for the projected Fed funds rate at the end of 2022 come December, basically. I believe that anything above a 3.5% basically Fed funds rate goal is going to be perceived as bad, because if our median is above a 3.5, there's a very good chance that there's somebody over there at the Fed that's saying 4+% at the end of the year. And why does that matter? Well, right now, as far as market expectations go, we don't have a lot of expectations for 4+%. We have some of that priced in, but not very much of that's actually like very priced in yet. As far as a percentage chance, I think it was like 33% of the market thinks that we could be at 4% plus Fed funds rate by the end of this year. But if all of a sudden we have board members even talking about 4+%, well, things have got to move, and projections have got to move, and estimates have got to move. And so the target rate for what we might be at the end of the year might move up in our market predictions. And guess what? When the things like that move up, markets go down. Literally over the last week, you've seen it yourself. The projection for what the Fed funds rate was going to be a week ago was about a full 100 basis points lower as far as what the market was pricing in. Now we're pricing in about a whole 100 basis points higher, or a whole percent higher at the end of the year. And you've seen the decimation that's happened in the market over the last week. So, I mean, you get an idea of why this kind of stuff is important. So yeah, anyway, guys, that is kind of just a quick little roundup video of what could happen today with both the Fed funds rate as well as the summary of economic projections. And again, like I had mentioned earlier, we will go through this more in depth. I'm going to be shooting a video actually in the studio later today, and you know, really going deep into the summary of economic projections to kind of give myself a good outline of where I think markets could be going from here, and make sure they also provide you guys some perspective of where I think markets may be going from here. If you guys did enjoy this video, once again, make sure you hit that subscribe button down below. Do me a favor and hit that like button, as this content is totally free. The only thing I ask of you is to hit that like button for me, as it does help me find more viewers and It does help me get this video out to more people. It helps the YouTube algorithm. All right, so anyway, yep, we'll see you guys in that next video. Bye-bye.